Doing great on this Tuesday, ahead of tomorrow's FOMC's Fed decision day. Tomorrow, the Federal Reserve is expected to cut rates. 25 basis points, 50 basis points on the table, perhaps. 25 basis points, 50 basis points, does it really matter? Fed beginning to cut. What matters is obviously going to be what are their projections into the end of the year? Are they going to be signaling 75 basis points coming into next year? Powell getting ready to go home, pack up his stuff, get going. New Fed chair expected to be even more dovish. Two-year bond futures expected to be the trade. Fed cutting with GDP at 3%. Remember, you guys, I loved Fabigo. It's time to put the work in. It's exactly what we're here to do. A lot of people want what's easy. What's coming? Tell me right now what's coming. What do I need to do? I'm not interested in taking a second to have to figure out hard things, to make difficult decisions, and make sure that I make good choices. That's what we need to do. That's what we do when we put the work in together. We got a lot to talk about today, and we're going to put it all together. And it's not some type of sensational clickbait thing. Now's the time to prepare. We're going to talk about it. It's very serious. That's a good filter right there for those that don't belong here and need to go. You know, we got work to do. Now, let's start off with the good stuff here. Let's see what's going on over here with our positioning. Stocks, 4 out of our 6 templates in the market. We still continue to see MicroStrategy on the sidelines and NVIDIA out on the sidelines. We went from just a week ago 100% into cash as far as equities, and now we are 4 out of 6 of our templates into the market. We're looking at FNGU and TQQQ up at roughly 6%. Tesla up 13.5%, and we're looking at the IBIT currently here trying to get off zero over here, almost 3/4 of a point up into profit. Out of Bitcoin bull runs, remains in the market ahead of tomorrow's FOMC. I imagine that Bitcoin will like Fed backing off here on its tight monetary policy. A lot of people are talking out on Twitter, and they're like, "Come on, guys, who would have seen in 2022 the most aggressive rate hike season coming out of the Fed?" We put up that tweet from October 16, 2021. The coming rate shock. Looking at the macro, we're going to be looking at the macro today, that's for sure. We saw over here. We're so close. Saving a butte. We saw her over here. What's going on? Hold on one second. I like this over here. By the way, Dog and Nation taking a look today at the dashboard on the Cardano. It looked like Bitcoin and Ethereum were about to close. We see over here that we are still heavily allocated ahead of the Fed towards crypto. Now we have 8-hour time frame, 3 signal periods a day. We have another 3 signal periods to go through before the Fed's decision. We're going to need some upward momentum here to take off if these trades are going to stay open. I personally, you know what? I remember 20 years ago, FOMC days. Yeah, let's go big. Volatility, we'd love to. I have no problem with taking the cautious stance. I'm going to follow the templates. If out of the market, that is a great place to be. If we're in the market, let's go. Tomorrow's going to be a big day. No doubt about it. We're pretty heavily positioned across the board here. We went from on zero to pretty heavily positioned across the board. All right. NASDAQ defying gravity ahead of September seasonalities. And guys, don't forget, at the time of the first cut, the data suggests whether they're cutting into normalization, whether they're cutting into a recession, whether they're cutting into a panic, none of them have a green outcome the first month. Historics suggest that the month is slightly negative, unchanged if cutting into normalization, down a couple of percent if cutting into a panic. Let's go ahead and bring it up over here just so we have the clarity that we want ahead of tomorrow's FOMC. Recession off 2% and panic off by almost unchanged, slightly negative. Now, moving out 3 months, wildly different. Look at what it's like cutting into a recession. Those first 3 months, on average, S&P off 15%. Now, the wild deviation continues. Are they cutting into a recession or are they cutting into normalization? It's a tricky question. Today we had some more hard data. We had retail sales. Retail sales coming in for 11 months of rising. The consumer remains strong. Wait a second, there's more to it. By the way, I think this is really important. This is a lot of people having, this looks different. Does this look different to you? Have you ever seen such a large relationship between the S&P 500 and job openings? Granted, this is only going back over here on the chart 25 years. Nevertheless, this looks different, right? This is, in the last 2 years, I wouldn't even say, clearly not. To the whole advancement of AI. Do you remember using ChatGPT like 18 months ago? It was like, oh, it's not even worth my time. And compared to today, you remember Boston Dynamics? Did you ever see the robots and you go back 10 years ago and they could like maybe walk? Today they're doing like backflips through the air and all sorts of crazy stuff. The rate of the growth of technology is absolutely exponential. Today, discrepancy, better than the word I used. I don't even know what I used there. Today, it's a very real thing that the advancement of these LLMs is causing entry-level jobs to see less hiring taking place, more efficiency by those that are there. And you're also seeing through a lot of technology companies, a lot of middle management being let go. Tech companies have major layoffs. Tech companies continue to be massively profitable. All right. So this is different. And is this going to continue to actually show a greater deviation? I like deviation over there. Retail sales today, I think this is a very important chart. The two are connected. All right. What we just looked at over here and what we're looking at right now, these two are connected. And what you're seeing in this chart, we talked about how a very real segment of the population is experiencing not just a slowdown, not just hard times, a depression. It's very real, and the printing from 2020 has caused a lot of people to be able to be priced out of the basics. Shelter, food, electricity. It's forget health insurance. It's impossible to afford, right? A lot of people are really feeling it, but we talked about this yesterday. We talked about the top 20%. And over here you look at the high income earners, the top 20% in green. They're the ones who are spending, and guess what? As assets are at all-time highs, they're thriving. They're not feeling the crunch of being priced out of just everyday basics. They're absolutely thriving and they're spending. And then you look at the very high income earners, right? The top 3.4%, and they're absolutely crushing it. And they're the ones that this is not much different than when we look at the markets and we look at the allocation of tech companies into the S&P 500 and NASDAQ. We have tech companies in the S&P 500 making up over 40% of the allocation of the weighting. And their earnings continue right now to be absolutely spectacular. So a lot of people are looking at the economy and they're looking at a portion of the economy, and they're not looking at, and it's very real, the crisis that we're seeing. We did a video on it last week talking about how people are really suffering. But there's another portion of the economy and the market that are absolutely thriving. Now, when that changes, that's going to be devastating. If you were to see the high income earners pull back on their spending, that's when all of a sudden the economy and what people perceive it to be is going to really meet the reality of what's happening. Check out this stat. High income Americans are behind roughly half of US consumer spending. It used to be a third back in the 1990s. So look at the last 20 years, what the Federal Reserve has done. Don't forget, when we started here together, we always talked about how the Federal Reserve has been the cause of inequality. A lot of people today, it's become like a political entity. In the beginning, we were all against the Fed and the Fed and one of the greatest injustices in the world. Today, depending on what people's, however they vote, now people are either support the Fed or not, either which way. And by the way, the Fed is always and forever will be a political entity. Let's bring it up on the board over here. Jordan, when rates first went up, your prediction was that rates went back down. It would precede a recession or crash. How do you feel about that now? Jordan, when rates first went up, your prediction was that when rates went back down, it would precede a recession. So the one thing that I think that I've been the firmest about, and this is going back from when the Fed cycle, and the way that I describe the Fed cycle is, anyone correct me if I'm wrong if you think otherwise, but I think I've been pretty consistent and loud about this. But the way that I perceive the Fed cycle is that after the Fed cuts, they begin cutting. Now, this time they did a 50 basis point cut and then paused a year. So it's like a reset, the way that market participants are seeing it. In my kind of black and white of life, I'm like, well, it's not really the first cut, but the way the market's perceiving it now, this is the first of what is likely to be this series of cuts. The last one was just a one-time event ahead of election because the Fed is not political or anything like that. And this time they're cutting, and what's expected is a series of cuts. So we're all looking about how quickly that series of cuts is expected and projected to come. And it's so funny that like the market's going to react to tomorrow, most of all, of the expectations of these Fed governors of what they think that the pace of the cuts is going to come. But these guys they have the worst track record in the markets. They're never correct on whatever they say. Nevertheless, we play the game, and then tomorrow, whatever they say, that's going to affect like the near term choppiness that we expect over the next month. But I've always said that the Fed cycle goes from when they begin cutting, that they're going to eventually stop QT. Does that happen tomorrow? And then when they stop QT, that likely the next thing that happens is the Fed's balance sheet begins to go up. Organic balance sheet expansion, Powell called it. And when that happens, risk is going to respond very well. That I've never said, as far as I know, that my expectation or prediction is that when they begin cutting, that the market's going to go down. Actually, I thought that I thought that belief that's out there on X as much as possible, which is why we've always looked into. I've had price over here. No one ever said anything. It's a big black line, and Ace didn't even say anything, which is why I've pointed out consistently for the last X amount of time the difference between if they're cutting into normalization and recession. That's what matters. Look at recession and normalization. Recession's at the very bottom. And if they're cutting into recession 12 months out, on average, market's down 11% 12 months out. If they're cutting into normalization, market's up 13%. So I thought that I've been throwing out the counter argument to everyone who thinks that Fed cutting means markets crash, because that's not what I believe. I believe it matters. Are they cutting into recession or normalization? And you can make the case that that a portion of the U.S. population, right, is already in a slowdown, and it's hard and it's terrible. And then you go down to the lower income, and they're in a depression. But unfortunately, that's a segment of the population, and it's not the overall. And those that are thriving, they're continuing to spend. The companies that are earning, they're continuing to earn. Are they cutting into a slowdown, or are they cutting into a recession, or are they cutting into normalization? One of the things that was holding us back over here, let me go ahead and pull this up over here. Um, One of the things that was holding the markets, you could see the green ones are things that are improving. Earnings are improving, right? Um, One of the thing that was holding back this like portion of the cycle we're in was Fed policy, ultra restrictive, QT running. Back then the yield curve was inverted. It's no longer inverted. Monetary policy, extremely restrictive. Now, are they going to keep QT has been greatly reduced. It's still running, but it's been greatly reduced. Is it going to stop? And when it stops, does their balance sheet stay flat, which it could, or is it going to begin rising? If it begins rising and they begin cutting, and by the end of the year they cut 75 basis points, and then by the end of the year the balance sheet's going this way, I think that's going to be conducive to risk. This is what I've said about the Fed cycle the whole time. Now, could they be cutting into a recession? Again, this is what we wrestle with. Today's data suggests that they're not, right? People are like, well, the job market is deteriorating. Yeah, it is. But which jobs are being lost? And the jobs that are coming, are people being paid more yet? You know, did we see the worst of it as we went through this transition with the new administration, and you saw a lot of people who did not have papers to be working here, no longer able to? Yeah, of course. Look what's going on with domestic workers. Are they gaining more jobs or losing more jobs? Now the jobs are horrible, right? A lot more part-time jobs, a lot less full-time jobs. A lot of people in that middle class working really good tech jobs, losing those jobs is horrible. It's hard on the households. There's no question about it. And those tech companies are becoming more and more efficient, right? They're going to probably continue to lay off. And as they lay off more people, it's better for their bottom line, more buybacks, better earnings, you know? And buybacks and earnings, that's driving the market like nobody's business. You know, something's going to have to change. We talked about yesterday briefly the passive bid, and we talked about Sherwin-Williams, the paint company, and they're stopped matching their employees 401k. Like, now you're on your own, and that's a problem if that becomes a trend across the board and elsewhere. That's something that's going to affect the passive bid that's into the markets. Is that happening tomorrow? Likely not. Likely not. So yeah, this is a tough one too. This is a great conversation by everyone. Um, it's probably going to take a while. Things take a lot longer than people perceive. One of the problems is we talk about reacceleration and how 5 months from now, likely the narrative has become that like, okay, the economy is really reaccelerating. Now, the issue with that is it probably won't for everyone. I don't, for example, those tech jobs that are being lost, I don't see them coming back into the market. I see that trend to continue, you know? And people have obviously played it out, and they're like, the only way in the future is some type of universal basic income. You know, we're far from that, obviously, and that's not happening. But you might see other areas that, like, as far as I look at it, retailers have been out of work the last year. The market has been stagnant, and they're not earning money. And if that market loosens up over the next 12 months, And then all of a sudden, that sector seeing more activity, bringing in more money. It's everything is complicated. Nothing is easy. Nothing is easy. All right. Markets over here continue to defy gravity and seasonalities into the Fed cutting. Obviously, you're all familiar with this is the most aggressive, highest performing track off a 20% drawdown. The one below it is the most similar to it, as in that was 1998. That was ahead of the bubble, of the dot-com bubble. The dot-com bubble was about what could be, what is the internet going to be? What was Amazon making money? Is Amazon making money today during this AI bubble? And it could be a bubble. Watch the earnings from Meta and Microsoft going forward. If that money stops, there's going to be ramifications, no doubt about it. But is this something of substance? What about the Buffett? I don't want to get this now. All right, let me get into this right here then. Let's for those who want to leave, let's talk about a couple of things. Yeah, a 50% probably is not going to happen. A 50% likely would be very people would be like, "Whoa, what's going on?" 25% really is meaningless, except it's going to if they're going to cut 75 basis points by the end of the year, that's going to carry more weight, right? And then what their projections are to next year. Let's start over here. Like, there's many ways to prepare. First of all, many people and I backload. So what I'm starting out with is not the punchline. All right. A lot of people are prepared because there's a countdown, 40 days, 4-year cycle. It's going to go. And, I don't see any indication whatsoever. And again, I've been super consistent about this, that outside of an adoption event, we are not about to see Bitcoin go parabolic. And the Fed cutting rates 25% is not an adoption event. You're dealing with a market cap that is significant today. And in order to raise the price, you need substantial buying to take place. Have we seen substantial buying? Yeah. This cycle has been phenomenal in so much as that we've seen a lot of corn go from early adopters into corporates. And Michael Saylor, he plans on holding, right? And he's going to hold. And these other corporates, unless they come into some type of insolvency event, they're going to hold. And they're all looking to add. And a lot of, you could have like a zombie Bitcoin treasury company who, let's say that they own whatever, like 10,000 Bitcoin, and they have no means to buy more Bitcoin. But if Bitcoin goes from $100,000 to $500,000 to $1 million, these companies, like, that's their lifeboat, right? Now you have other Bitcoin treasury companies who are on the bid, right? Metaplanet has plans, right? MicroStrategy has plans. 21 has plans. They're looking to bid and to buy, and they are taking corn that went from people who are no longer interested in holding and looking to diversify and looking to buy gold, and they're doing that with it. And that's all good, but it's a healthy dynamic that's taking place in order to get Bitcoin to go parabolic. And parabolic is at this point for sure. If in the next 40 days Bitcoin goes 170, 210, that's a parabolic move. That would be pretty sweet. That would be pretty strong. Let's check this out. Now, that would be top channel anyway, right? That 210 is above it. And I feel funny even saying that. If it broke 210 by October, in the next 40 to 50 days, then likely it's not stopping, and it's going to go up. But you guys are all very smart, and you're very aware of the amount of money that has been pouring into Bitcoin these last 6 months, and you see where price is. Like, where is Saylor going to get the money to be able to move price? Unless he starts buying the bid on the exchanges, it's not happening, obviously, right? Now, so maybe Bitcoin doesn't enter a blow off top. Maybe a lot like last top, it just peaks with a whimper, you know? And if so, watch out. If you break this trend line over here, we called the bull market in December 2022. We said this is the bull market breakout. And if price breaks this trend line down here at any point in time, it's over. De-risk. I had no idea that price was going to hit a new all-time high prior to the halving or be here today. You never know when it's going to end, except that it hasn't yet broken that trend line. If it breaks that trend line, which is coming in right now, somewhere around 83,000, look, that something's not right. That's wrong. Know in advance, de-risk. De-risk can mean different things for different people. Now, check out the amount of drawdown that you'd be looking at to go from the all-time high into that level, 30%. I think everyone here knows that since the bull market breakout, there have been multiple drawdowns, none of them exceeding roughly 30%. And a 30% drawdown, that might be amongst the norm. And a lot of people might say, I don't want to de-risk. I'm good to hold. I've been through multiple 85, 84, 76, and 60% drawdowns. I don't think it's to my advantage here to actually sell any Bitcoin. Actually, I'm going to buy more. Just have a plan. Now, there might be some people out there who have loans against their Bitcoin. That might be a good idea to do whatever you need with your LTV or pay it off or whatever you might want to do. Or some other people might say, you know what, that seems like a great time, 30% drawdown. I might want to borrow against Bitcoin. And I might want to buy more Bitcoin. That's a 30% drawdown. Yeah, Bitcoin might come off, another 50%, not another 50%, total of 50% or even 60%. But I feel pretty strong about it. And I think $55,000 Bitcoin is cheap. Now is the time to have a plan. And is it because the 4-year cycle is happening and the next 40 days suggests the top? And the reason that it suggests the top, because, well, it's just that's what it's been in the past. Well, no, but we spent so much time talking about that. I'm not talking about that. I'm not telling you what to do. I'm telling you be prepared if that trend line breaks, which hasn't broke since the Bitcoin bull market began. That would be different and that would be interesting. I guess I wanted to show you. I don't know if I'm going to. We'll look at this tomorrow together. Because I could make the argument that this upper line here, resistance would be a little higher, no doubt. Ever since the 2018 bear market bottom over here, right? Outside of the global lockdowns, priced, maintained above it into that break of 35K. And then it's like we entered into a lower deviation. And that's the deviation that we've been inside. So a break of this line, could that take us back towards a past deviation? And here you could see the low of it, right? Coming into here, just for a price number to give you a price of where that is. And that's right around by the time that would happen. I don't think that, I remember this very, very clearly when price fell 50% in like, in an instant, I'll call it. Fed hiked over here. November. Markets did not like that. Boom. Finally, after this massive triangle, markets dumped 50%. And then, I don't see an event like that happening right now. If it were to happen anyway, that line coming in, let's say by January, just under 55,000 Bitcoin is cheap. Anyway, just a little bit of awareness. We will look at that further. My expectation is that what's going to occur, and what's going to occur is if we don't have a blow off top, into the next 40 days, 50 days, it's you could see the cycle come to a top without the blow off portion occurring. And if that would happen, that's why I'm pointing out your greatest risk, that bull market breakout trend line of that important invalidation, because the market doesn't need to go parabolic as most 4-year cycle theorists believe it's about to, and it could break down with that happening. So if the market goes parabolic, that's an easy one for you, right? And if you want to distribute any Bitcoin, take some off the table, buy back lower potentially, it's going to be a lot easier than if things happen that you don't expect, and that's not that parabolic rise. And a parabolic rise today seems to be like something into 170 to 210, right? I think that's fair to say. That would be parabolic if it were to occur in the next couple of months. But likely what happens is neither one of those things happen, whereas we don't break down and we don't break up. And likely what happens is that we're still in the sustainable channel. And then people will say, oh, no, well, it's to the end of the year. November and December have the most favorable seasonalities for Bitcoin. So the 4-year cycle is just off by a little. And then if we're still in the sustainable channel, likely what it is, well, it's going to be the first quarter of 2026. So we still got a long time to go until people are going to embrace that something has changed. And then that point, is going to be likely by the summer. So here you have January 2026. By then it should be very clear that something is different. And then again, it's going to be into that first quarter. People are going to think something is different. And there we go, riding the wave. So we talk about things being different, or we're talking about things being different. And this is really different. And gold has been the most overbought now in its entire history. And there's a good reason for it. Obviously, we are seeing central banks buying gold, owning more gold now than US treasuries. And there's an absolute reason for it. And there's more reason than one. And I'm reminded of the chart we haven't looked at in a minute. And that's the chart of watching gold and Bitcoin off of the bull market breakout, right? You could go from another part is where Bitcoin topped 2021, pretty close, right? This is marking from a market top, that's from a bottom. You go in between, which one is the faster horse? Obviously, you all know that, but I'm talking about gold. And a lot of people could be looking at the dollar and saying, well, the dollar's not really off that much, right? The dollar is, I mean, it's off a lot since the election. It's off, 11, 12% since the election. What's up, JDK? And, but go back a couple of years, the dollar has basically been here, for the last 7 years. And, that's the mean of where we are right now. And when you look at everything priced in dollars getting obliterated. You look at equities, you look at housing, you look at gold, you look at silver, you look at Bitcoin, everything you look at, the dollar is getting obliterated. But when you look at the DXY, you're like, well, it's just level. But the DXY is measured the dollar versus other fiat. And other fiat is getting leveled also versus these assets. And right now, what you're seeing is not a bubble. Here's a good way to check it out. A lot of people are looking at the NASDAQ and they're like, NASDAQ is getting absolutely obliterated. It's flying and it's in a bubble. Don't forget, today's bubble is a little bit different than the 2000 bubble. First of all, it's a little bit earlier than when it became a bubble. And most bubbles, their final moves, their final third is when they make up roughly half their gains. We're not really experiencing that today, but I think it's really important to give a little perspective. First of all, here is November 2021, December 2021, when the NASDAQ peaked. Versus gold, it's significantly lower today, right? But check this out over here. This is the dot-com bubble. And this is price versus gold instead of price versus the dollar. Look at the S&P 500. S&P 500, here you go, the dot-com bubble over here. Here's S&P priced in gold. And I think it tells a lot different story. I think a lot of people are not really realizing that what we are seeing and witnessing here is the collapse of fiat in real time. Now, this doesn't mean that this time is different and then from here in we're about to see a crack boom and we're about to I mean, it doesn't mean it's not going to happen, but that's not what I embrace or anything like that. I'm trying to basically maneuver what normally for the past year has been within a 3-month time frame, and now we've extended it out almost a year, right? We're looking out towards, well, Fed cutting is a big deal. We're looking at obviously midterm elections, really big deal. That's something that could definitely put an end to this current run over here. A lot of people are getting into a lot of certainty that the markets have come too far too quick and are about to take a turn. I do point towards, the turn that we just experienced in April. In April, we did see a massive 30% correction on the NASDAQ. And since then, yeah. So I think here when I talk about be prepared, this is a very fine line to work to walk over here. Guys, yeah. I can't really answer that for you. What I want to say here, what the punchline is. I can't really get into it for you. I'm gonna leave it to see from the comments who gets it and who doesn't. And we're just gonna take it then step by step. Looking for my chart of Bitcoin and gold. There we go. And that right there. Mining stocks about to go parabolic or crash, or maybe none of those things happen. The markets don't have to crash, and the markets don't have to go parabolic, and the markets could kind of muddle through. And the markets could continue muddling through until something changes. Some of those changes could be if we were to see a turn in the direction of earnings. Now, some people could say or argue, the tariffs are not being passed on to the consumer. Therefore, it must be the distributor, the companies that are eating these profits, that's going to eat into their profits. I mean, tech companies though, they're immune from those tariffs though, right? They're not feeling any of that. We would need to see a change in direction of earnings, which have been continually rising, as well as their estimates. We would need to see the retail of the consumer in the US pull back. They pull back, earnings are going to go ahead, they're going to pull back. We're not seeing any of those two things yet. We are seeing what is a clear deterioration of the job market. And what that's doing is causing the Fed to have to go ahead and meet one of its mandates, which is a secure job market. And that is going to help, obviously, liquidity, which has had this like choke point against it since April 2022. And with that happening, you've seen risk continue to rise and run, right? Now the Fed, which was the one thing monetary policy holding back the extension of this current market run, begin to get more in line with what would be conducive to growth. There are other factors out there that are inhibiting the growth. One could argue that for sure that the tariffs are that. So we might not, that acceleration might be more of a muddle, and that there's a good chance of that. A crash, what could trigger and or cause a crash in the next 90 days? That's something to really really think about. And what could cause some type of melt up and why? I think those are two good things to talk about. No way. Who said this? So if you we just had a 30% pullback in April, and we've had since 2023 Bitcoin multiple. What have we had? Have we had three? I'm not exactly sure. We've had probably three 20% pullbacks, probably three 30% pullbacks, más o menos, and that's just normal. And I'm sure there'll be a time when we have more than a 30% pullback. Only my belief is that that occurs after you see something like, let's find the easy chart here. Here's a sustainable channel. Let me draw it in. So if you were to see at any point in time a move towards the top end of this channel and or break above it, especially break above it. If you see a break above it, that's likely going to lead to a rapid price acceleration and then a mean reversion. That mean reversion likely comes back towards this channel. That's easy 40% drawdown. Easy. From the top of this level, and just so I have an understanding from the top to the bottom, how much of a drawdown it could be. Easy 40% drawdown. To think that there's only going to be 20% drawdowns between now and 2029, Jay, I don't know how you even form that thought. It's like there could easily be a 40 to 60% correction easily. Between now, a lot of people are expecting Fed's cutting rates, QE's about to come. They're not even close to running QE. They're still running QT. And there's going to be a lot of finagling in between. They're only running QE when something breaks. And we are so far for something breaking right now. Liquidity is ample. And when something breaks, you bet that could happen at any point between now and then, we'll call it. You said 2029. S&P 500. What did the S&P 500 pull back as the Nasdaq pulled off 30%? This is the DXY. I don't want to get off that, and they could just come jump over here. In April, because 22%, you know, there. I see you now. Oh, in a 100-year cycle, I don't know. I don't know about that. It could be. I just don't know anything about it. Listen, markets just had a massive correction. During that massive correction, S&P was able to pull back 20%. That was a massive, massive uncertainty. Don't forget, remember Ray Dalio? Remember how bullish he was on China 2021, late 2021? And I don't think that many people that were focused on that market saw what was coming and came. And you have to realize between then and today, China's gone through this and continues to go through this slow motion deflationary bust. But as other central banks worldwide are moving from that tightening and then moving towards easing, that's going to give China the ability, likely, to be able to put the gas on as far as their injections towards easing and come on a little stronger. And, it's hard when you're fighting the rest of the globe. When you're on the same side, central banks, when working in unison, are very effective. Someone asked a question about the 30-year. Why is the 30-year dropping? And, probably a lot of people are stuck on what happened a year ago. And so, guys, my expectation, inflation 9.1. Sorry, I'm just going like this. Inflation 9.1. It took about 3 months longer from when we called the top for it to roll over. Rolled over, bottom, came up, came down, and it's like this now. And a lot of people are worried, well, the Fed's cutting rates here with elevated inflation, and that's likely going to lead to more inflation. And the reason it's likely going to lead to more inflation is because likely it's going to spur growth. If the markets were about to crash, then people would obviously not be worried about the ramifications of what this is going to lead to, which is ultimately going to be higher inflation. Only that higher inflation is likely not going to come until later down the road, when longer than people expect. People are like, this equals 4% inflation. How long is it going to take to get to 4% inflation? What's the greater odds next year into 2026? Especially if you see long end of the yield coming down, 10-year coming down, does that mean mortgage rates will come down? And if mortgage rates do come down, that opens up more of the market. More of the market's opened up. What likely happens? Prices likely come down further. If prices come down further, is that inflationary or deflationary? You know, and likely 2026, what's inflation right now? Call it 3.1. Do you see it? It might be it might be lower, and there's a good chance it could be lower. Shelter's such a large portion of how they measure inflation. And are is the 30-year eventually going to break out to the upside? I think a lot of people get everything are able to see very clearly about what is happening and what the ramifications are. And I think that adjusting the time frame in which these events unfold is another thing. Yeah, so for sure, I'm glad you mentioned that. If you see at any point in time the Europeans place troops into the Ukraine, that's probably not a good idea. I mean, that's probably not a good thing. And, you know, is that going to cause spendings in the United States? By the way, I don't, that's not a good thing. That probably puts a bit into gold, if anything. But let's just pray that doesn't happen. And if you were to see the fiscal situation in France deteriorate further, and you're likely going to see some type of accommodation, right? Very quickly. You remember how quickly the Bank of England was to act when the gilt market was coming under pressure a year and a half ago. They were like, we're going to backstop it no matter what. And they wound up spending $5 billion. They whatever it takes was put out there, and that was enough. They'll be very quick to accommodate if need be. It's going to come down to what happens in the next few days is noise, I think, and it's going to come down to what we see the expectations for them cutting into the end of the year. It's going to come down to what Powell communicates. Are they cutting and they're going to make it sound hawkish? Market's not going to like that, right? Do they cut and do they come off dovish? Risk is going to respond very well. But at the end of the day, nothing that happens over the next month, especially tomorrow, is going to change the current dynamics at play in the markets. Not one thing, nothing. And more than likely, into the end of the year, markets are moving up. That's my expectations. I know a lot of people are looking for the top, and look top right here. Listen, we'll do our best to stay on the right side. I don't think there's anything easy about it. And right over here on the Nasdaq, right, green line is the first indication that we have a breakdown in play, and that breakdown, come over here, and that breakdown likely taking us to test the previous all-time high breakout. And if that happens, likely doesn't hold, and then we're coming down towards this pocket over here. That would all be well within expectations if any of that occurs. We've looked at that before. Now, if that's happening, the doom is going to accelerate. That's for sure. All right, you're all. We'll keep it here until tomorrow. Tomorrow's a big day. We'll just get balanced ahead of time before Jay Powell tomorrow morning take a look at the markets together, take a look at our positioning, and then we're going to reevaluate depending on what he says, depending on how the meeting comes off. Did it come off dovish or hawkish? I mean, they're cutting, that's dovish. Do they stop QT? What are their expectations into the end of the year? All of that matters. We got the drama with Trump and Cook and all of that nonsense. I'll be interested to see if there's one outlier. You know, does she come off ultra hawkish just to troll him? He deserves it. I hope he gets trolled because he's the master troller. That would be funny. We could laugh a little. Hyperwave. So some people talk about Bitcoin and the hyperwave. We should do a session on that, right? We should do. Were you guys around in 2017 with Tyler Jenkins and the hyperwave Bitcoin theory, and all market? We could do a whole session on that, and it didn't play out last cycle. A lot of people think that is now going to play out this cycle. What we're looking at is this, though. By the way, this is the greatest risk, right? That this line continues to hold. That's the greatest risk out there for people. This is more realistic. And this is what I believe is happening. Don't forget, we put this out over here in December 2022 when we didn't get the blow off top. It's uncanny how similar the tracks continue. This is just reflective of what an asset undergoing S-curve adoption exhibits. That's what it is. That's why I had that thing hitting in the beginning. The price scale on the right is absolutely irrelevant. That's not what this is about. This is showing to you that, yes, likely we're going to see diminished volatility. Diminished volatility to the downside. This is still 40% correction right over here. This is probably a 30% correction. Bitcoin's a different asset. It doesn't mean it's only going to have a 40% correction. I could easily see 40 to 60%. Guess what? That's massive diminished downside volatility. Same thing on the upside. And Bitcoin's volatility could even be greater on the upside. Who knows? Than comparing here a similar asset. Rhyming. And that meaning that instead of seeing log scale regression, no, exponential growth. Walk up. That's what I'm looking at. That's what I believe happens. Now, it's true. A lot of other dynamics definitely are at play here. One of those dynamics, though, is the current state of the market, right? We've looked at the importance today of fiscal dominance and what it means going forward. They have to service these debts as it gets under control. They got to spend, they got to print. There's no other way around it. They're not moving towards austerity. There's no way. And we'll continue at it tomorrow. Listen, everyone, lots of love. Thanks for the conversations. Thanks for smashing the like button. Thanks for entertaining. So if there's some type of hyperinflation, okay, but what does that mean? Did you ever guys? Let me talk about this for 1 second. First of all, we can't predict what's happening 30 years from today, and I think into the end of the decade, 2030, that's extremely far away. Let's not move beyond there, right? When we get there, we'll be looking at 2035. That's a long time. Sharper, more violent, quicker cycles. It's crazy what's happening here. Monetary reset is happening. And if you don't believe me that monetary reset is happening, just look at the chart of gold, right? And obviously something's different. And we can't look out 30 years and we can't have any idea of what the purchasing power is going to be of the dollar 30 years from now, right? Did you see Fidelity? Fidelity, $12 trillion Fidelity, huge institution. They were very early into Bitcoin, by the way. I think 2015 they began mining Bitcoin. Obviously, Fidelity has they talked about like, is anyone aware of the numbers they put out like of one coin, 2035? Uh, Ridiculous numbers. But what matters, like, we can't do that. But we have no idea. And we have no idea what the value of the dot 30 years from now, or I think 5 years or 4 years from now into the end of the decade. Let's try to, that's looking long term right here, you know? So let's focus on what the CAGR is going to be between now and the end of the year. And what do you think it is? Do you think that the CAGR is going to be 30% between now and the next 4 years? I think it's going to be greater than that. I think it's going to be much greater than 30. We'll see. We don't know. And what happens if we have a deflationary spiral like China in the next few years? Maybe the CAGR is negative. It could happen. Thank God for knowing when to be in the market, when out, and on what side. All right, everyone. We'll see you tomorrow. Have a beautiful day. God bless you. Thank you for being a blessing.